welcome back. I hope you all enjoyed the wonderful pork tenderloin lunch. It was a great time out there. Yeah, nice little Midwestern treat. The ice cream snacks were good too. So this is going to be a nice enlightening conversation that'll keep us awake right after lunch here. We have a gentleman who needs no introduction, but we're going to give him one anyway. So please join me in welcoming one of Monmouth College's most dedicated alumni and influential leaders, Bill Goldsboro, class of 1965. Bill's remarkable career has spanned education, banking, and investment, including roles as vice president at Lincoln Capital Management and investment officer at Harris Bank. He also taught economics and business administration at the University of Wisconsin-La Crosse. A proud Fighting Scot, Bill earned his MBA from the University of Chicago in 1966 after majoring in government with minors in business administration and economics here at Monmouth. As a student, he was active in Sigma Phi Epsilon, the swimming and tennis teams, politics club, Blue Key, and even spent a semester in Washington, D.C. Bill's devotion to Monmouth is second to none. His service includes nearly 40 years on the Board of Trustees, including 5 years as chair. He's also served on the Alumni Board, led regional and national campaigns, including co-chairing the Forward to the 21st Century campaign and chairing the Light This Candle campaign. And Bill has been honored with every major alumni award, the Distinguished Alumnus Award, Distinguished Service Award, and induction into the Hall of Achievement. It's an honor to have him back on campus to share his insights with us today, so please join me in welcoming Bill Goldsboro.
Thank you very much. Actually, my name is Warren Buffett. Testing 1 billion, 2 billion, 3 billion. So, are we having a good time here? Yes. Okay. This young lady over here, she and her staff is responsible for all the good things that we've had the last week. Now we have, a lot of you were here for Golden Scots. We have 2 members of the faculty that are here, Mike Connell, Dick Johnson. So when we're done, they're going to give me a break. I've got to be real careful. So the name of this talk is Individual Stocks or Index Funds, which is better. Now, a better name would have been active versus passive. Passive management is just buying an index fund and participating in the markets. Active management is trying to beat the market. So our question today is, which is better for most individual investors? So let's take a look at some of the data that I gave you. Let's take a look at that first page. It gives you returns for almost 100 years. And you can see the S&P 500 basically really outperforms everything else. Compound return 9.9, cash 3.3, real estate 4.6. But when you go out for long periods of time, a small difference in a rate of return ends up in a major difference in the terminal value. Look at this box on the right-hand side, and look what happens to $100 over this 99-year period for these 3 main asset classes. And what it tells me is you don't want to be in bonds, you don't want to be in cash. You're going to make the most money in stocks. Now, it's not quite that simple. There's no free lunches in there. There's some problems owning stocks. And let's turn to the second page of the handout, and this gives you annual returns from 1928. And here's the problem with stocks: volatility. They can go down a lot, and this even understates what the volatility could be. You can see very good years, very bad years, on average, very good number. Now here's a question: how could bonds give you a negative return? Well, bonds prices and interest rates go in the opposite direction. So if a company issues a 5% bond, 5% coupon on a bond at $100, and interest rates go to 7%, that bond isn't worth $100. It's probably worth about $73. So you can lose money on bonds if interest rates go against you, i.e. go up. So that's what happened in this particular year. I don't even know what year it was, but bonds lost a lot of money. Probably was in the late seventies when inflation was kind of out of control and the 10-year treasury got to 15%. So bonds, stocks are volatile, they give you high returns. Now the third page, I did this just for my own interest. Here's all the bear markets in the last 100 years. And they sometimes happen quickly, sometimes they take 2 or 3 years. But what's kind of interesting is that in my investment lifetime, in the 2000, what I call 2000 aughts, we had 2 major bear markets, 2000, 2002, and the worst one since the Great Depression in 07 and 09, over 57% the S&P was down. Of course, that means, 500 stocks, a lot of those stocks were down 60 and 70 and 80%. So stocks carry risk because of the volatility. We can't do anything about it. But the long returns are very good. So how do we solve that problem? I don't want a lot of volatility. I get nervous about it. But I don't want the return on cash. Cash is going to make me much money. Just going to barely keep me ahead of inflation. So let's talk about investor behavior. We as individual investors have any advantages in the marketplace? Do we have an informational advantage? The answer is no, of course we don't. Institutions, hedge funds, private investors, partnerships, commercial banks, insurance companies, they have people who do this full time. We don't have any edge over them. Do we have any behavioral advantage? We could, but we don't. Let's look at this next chart. This is from a company called Delvar, and they measure investor behavior. Now, there's 2 types of rates of return for a mutual fund or an exchange-traded fund. There's what the stockholders get and what the company reports, and they're not the same. And the reason they're not the same is Delvar looks at the cash flows during the year going in and out of these funds. So the investor return is dependent on how successful. Are they buying at the bottom and selling at the top, or the other way around? Well, they're not very good. Look at this chart. This is a 30-year average. S&P up 10.1, average equity interest is only up 8%. So we, as a group, individual investors, are not good timing. For that matter, most professionals aren't. The market timing is really tough. I'll give you a brief example. In the 74 bear market, 73, 74, it's a long run. In November of 74, right at the bottom of the market, Warren Buffett came out and said, it's time to buy stocks. And he picked the bottom almost to the week, which is hard to do. So let's fast forward to 2007, 2009. In 2008, in the fall, October, Warren said, I'm buying America. In other words, stocks are cheap. From that point, the market went down. The S&P would decline another 25%. I'm not criticizing him. He's a smart guy, a very smart guy. Timing is difficult. If it's difficult for him, how are we going to solve it? The problem is fear and greed. When the market's low, when it hits a new low, nobody rings the bell and says, this is as low as it's going to go. You don't know. So it starts going up a little, and it's been doing that on this whole decline. It starts going up, and you don't know if it's for real, so you wait, and you start getting in, and you get in too late, and you end up, you look what's happened recently. After the market's gone up, and your next door neighbor's made a lot of money and bragging about it, you have it. You climb in the market, and you end up buying too high. And then the market rolls over and it goes down, and it's down 20%, 30%. Finally, you capitulate and say, God, I can't stand it. And you sell close to the market. So we're not good timers. We don't have a behavioral advantage. So even if you're fortunate enough to pick a great company, and I'm going to give you 2 great companies to show you how hard it would be to hang on to those stocks. The first one is Apple. We know it's a great company. It went public in 1980, $22 a share, adjusted for splits. I'm going to have to get my glasses on here, sorry. They had 5 splits, one share is now 224 shares. The split adjusted price is 9 pennies, 9.8 cents. Yesterday's price on Apple was $203.92, up 2,076 cents, or a rate of return of 19% a year for 40 years. That is awesome. But along the way, Apple stock declined 70%, 3 times. Now think about that, 70%. Your $10 million is now worth less than $3 million, or your $100,000 is worth less than 30. At some point, you're going to say, I made a mistake. This isn't working. It wasn't what I thought. It's hard to hang on to these big winners because they're very volatile. Amazon went public at 18, and I need some help. In 1999, four splits, 240 shares from one. The price of 7.5 pennies is the adjusted IPO price. It closed yesterday at $213 a share. Compound return over that period of time, 22% over 20 years. So it's hard to pick them. We can't time the market. Fear and greed have us do things at the wrong time. That's the answer. Okay, now I'm going to share with you a report titled, this is a research effort by a professor at Arizona State University, Hendrik Bessenbinder. Do stocks outperform treasury bills? That was the title of his paper. Well, that's ridiculous. This guy's a PhD. No stocks outperform treasury. We just saw the numbers. It's enormous. Why would he do this? Well, let's be a little careful. When he says stocks, he's not talking about an index. He's talking about all stocks. He looked at the monthly returns of every stock over a 95-year period going back to 1926 and compared those returns to treasury bills. It was over 3 million transactions. Used the data at the University of Chicago, what's called CRISP, Center for Research into Securities Prices. And I'm going to give you, I've just kind of summarized this paper just for my own benefit, but I'm going to give you just 4 of the highlights. The entire gain in the U.S. stock market since 1926 is attributable to the best performing 4% of stocks. Let me repeat. All of the gain from 1926 to, I think, the study in 1970 was 4% of stocks. That's 1,000 stocks out of over 25,000. I think most people in our business, most academic people, had no idea that it's only a few stocks that make most of the return. The top 86, 1/3 of 1%, accounted for half of the wealth creation. 86 stocks out of 25,000 plus. What are our chances? The answer is, I think, not very good. Let me give you a couple other quotes here. While the overall stock market outperforms treasury bills, most individual stocks do not. Over half the stocks, 57%, lag treasury bills. We know the returns on treasury bills aren't very good. Almost all the time, they're not very impressive. You buy them for safety, security, but you don't buy them for return. If we took all the returns of all these 26,000 companies, ranked them top to bottom, we took the middle return, which is the median, that number is a negative number. So half the stocks have negative returns, over half. So, let's talk about the implications, what that means. It means stock picking is tough, very tough. It's beyond most of our abilities to really do it well, actively. So what do? You buy the whole market. You buy the S&P 500. You're gonna own those 20 stocks, or 18, or 22, that are gonna be gigantic winners. You don't know which ones they are, and you're gonna own a lot of crap and things that have negative returns, but you're still gonna get that 8 to 10% return that you're not gonna get in bonds, and you're not gonna get in cash. So the answer is, for most people, index funds are the way to go. Now, I can't stop right here, because I gotta give you a ticker or two going. It's just not fair to not talk about the market, not give you some idea. So let's go to this second to last sheet. It's got all this data on S&P funds. Let's look, the top two, what I've done is Vanguard has a lot of index funds. They're the pioneer, they're the ones that developed the whole concept. Jack Bogle, when he was at Princeton, wrote his senior thesis on index funds, turned it into a company. It initially was not very successful. Investment professionals said, we want to do better than just the market. That's not a very ambitious goal. We want to beat the market. But what happens is, Morningstar tells us, the most professional managers lag an appropriate benchmark, which in many cases is the S&P 500. So what I've done here is I've looked at the two, just from a curiosity standpoint, from a style standpoint, what's working and what's not. S&P Growth ETF and the S&P Value ETF, both Vanguard funds. You can see growth has beaten value pretty significantly over the last decade. Now, the growth stocks have a higher return, they're more expensive, and they've got lower yields, which you'd expect. The value stocks have a higher yield, lower return on equity, and lower PE ratio. So the third line down is just the S&P 500, VOO, and you can't buy the S&P 500, but you can buy S&P 500 indexes, and you can see the funds there. And interesting enough that the terminal date is April, that we had a correction this year, and it ended, or it was right around, ended close to April, so the year to date is actually up slightly, but that's a little bit of an anomaly. But the point is, those are the numbers over 1, 3, 5, and 10 years, and below is the S&P, I'm sorry, line 3 is the Vanguard fund, line 4 is the S&P, I got it backwards. And you can see that the numbers are pretty similar. We call that tracking area, not tracking. And they track very close. Now, you look at the top two, you see growth has outperformed value. But long term, the two are pretty close together. So what I would think might make sense for people is this last fund down here, the Invesco Equal Weight Fund. Let me explain the difference. The S&P is a market cap weighted fund. Market capitalization is number of shares times the price. So the biggest stock in the S&P is Apple, about 7%. And Microsoft is right. Google is right. NVIDIA is right. And the top 10 stocks in the market cap weighted S&P are over 35% of the total, the highest capitalization has ever been. So the S&P market cap weighted is very heavily concentrated in a very small number of companies. Over 1/3 of the index, 10 out of 5 companies. And those companies, as most of us may know, they've been great stocks the last few years. Wonderful stocks. They're great companies. They make a lot of money. They have high returns. They spin off lots of cash. But they're expensive because everybody loves them. Everybody knows how well they're doing. So an alternative, not instead of, but in addition to VOO, would be RSP. Now that's the equal weighted fund. Every stock is 0.2% in the equal weighted S&P. And as you can see up above, it's lagged badly over just about any period except year to date. So my suggestion would be, if you find indexing attractive, and I've done this with my daughter's IRA. I have her in both of these funds, VOO and RSP. The last page here, again, gives you, I wanted to see how far back I could take RSP, and I wanted to know as long as possible how it compared equal weighted versus market cap weighted. And if you go to the far right-hand side, we've got 34.5 years, and the two funds are very similar. So, you know, over shorter periods of time, look at the 1 year, there's a huge difference. So I would think if somebody finds indexing attractive, and a lot of people, they don't have the interest, the inclination, or the time to be messing around in stock market. Just put it in an investment and forget about it. Let the market take care of it. Own those 20 great stocks. A lot of garbage with it, but that's okay, you're still gonna get good returns. So that's kind of my recommendation. You wanna own an index and not individual stocks. Now, individual stocks are more fun. So, I think a lot of us might want to have a little side pocket. 5, 15% of our net worth, and, you know, play around and have a little fun, and try to beat the market, or play crypto, or, you know, there's all sorts of interesting ways to try to make money, but it ain't easy. It ain't easy. So, I'd like to take questions now. Dick, what do you think? What did you like or didn't like?
Well, when I look at stock, whether it's a fund or an individual stock or anything, I buy it with real money, and when I sell it, I get real money.
Right?
But in between those two times, it's monopoly money. It's going up and down, up and down, up and down. Monopoly money, worthless. Cause I'm not getting any of it.
Well,
So what I am.
depends if you're getting any dividends. A lot of
So
stocks
that's
pay
the
dividends.
next thing.
Okay.
I'm a dividend investor.
All right.
And my rules are, you don't buy anything that doesn't pay at least 5% because they're ripping you off by not giving you at least that much. And you don't buy anything more than 10%.
Because it's too risky.
Because they're trying to buy you into becoming a stockholder with them. So you got a 5% spread, and my dividends have remained constant or gone up as I've added stock. But I haven't had a drop in dividends in years.
Well, there's a group of funds called dividend risk credits. These are companies that have raised their dividend 25 years in advance. It's about 50 companies, and these are great companies.
I'm not buying them. They're too expensive. I got another rule.
Some of them are, and some of them aren't.
If I only look at stocks that sell for basically $10 to $30. Over $30, they're too expensive. Because at $200, you gotta take up the whole quarter's dividends on, maybe 500 shares or of stock X, because they're gonna pay like $250 or $300, something like that. So you only buy one share, but you wanna buy around one. So you gotta stay within the 10 to 30. And I'm having a hard time these days finding good stocks to buy in the range I like to buy in. And when they get up to $100, and I've got stocks that go up 500, 600, 700%. I sell them off at least down to 500 shares, because I only go up to 1,000 shares. I don't go to 1,000 because I don't want to risk it.
I've got some more handouts. Let's talk about valuation. You find that interesting. Ladies, can you help me out here? 50.
I like handouts.
But the question is, and it's the key question, is the market expensive? It kind of depends on how you define the market. And I'll wait till we catch up.
Hey, Bill, while we're waiting on that, explain the expense ratio vertical column there.
Yeah, that's just,
Where does that come from? Why
that's
is
the
one?
company that runs a mutual fund or an exchange traded fund, that's what they take as
That's a
for
cost.
their fee. And so you see the Vanguard numbers are very, very low. I mean, they are very efficient. The shareholders actually own the company. And they've got by far the lowest ratios. You always prefer lower expense ratio, just, you end up with more if that's low.
Yeah. Why would Invesco be 0.20? Why is it so?
Well,
much
it's
higher?
equal weighted, so there's probably more trading going on because they have to keep adjusting it every quarter.
Okay.
S&P has to add stocks to take them out, but there'll be less transaction costs, I think.
Okay,
But part of it's just Vanguard's more efficient.
thank you.
Okay, so the market has been very strong the last 15 years. I don't think most people realize how strong the market's been. If we take from 2009 to 2012, the market's been up 13 to 15 years, growing at a compound rate of 13.8%. So what's the next 3 years gonna look like? Well, I went back and I said, let's find another period of 15 years, maybe 2 periods, and see what happened the 3 years after that. We might learn something from that, we might not. So I went back all the way to 1926, and the first period I came up with was 42 to 56, 15 years, 13 up years, 2 down. Market was up 86% of the time. The returns were enormous. Compound annual return 21.6, way above the long-term average. $1 over that period became $18.50, 15 years later. That was a very nice time for the investor. If you were in the S&P 500. So the next period, so that doesn't tell us much. The next one, 85 to 99, 15 years, 14 of those years were up. 18.9% return. $1 becomes 13.25. But the next 3 years, every year's down. The compound return is a minus 15% a year. Not much fun. And you can see at the very bottom is the last 15 years, which I just mentioned. So this table that we haven't learned, it didn't give me much of a clue. So let's turn to the next page, the Shiller PE ratio. Robert Shiller is a professor, I believe at Princeton. He looks at 10-year average of earnings, calculates the PE ratio on that. I drew a line, that's probably not completely accurate, but it's fairly close to what the long-term trend has been. This is, today, this ratio of price to earnings is the second highest it's ever been. The market's expensive. The mean ratio is set up a little over 17 times, the median's 16. We're in the 30s. The market's expensive on a price to earnings, no question about it. But it can get more expensive and still more expensive. This doesn't tell us that we should sell today. It just tells us it's expensive, but we don't really know if it's going to sell because markets can keep going up much farther or keep going down much further than you expect and for longer than you expect. So it gives us somewhat of a message. Now let's turn to the next page. This is the yield on the 10-year treasury, safest bond in the world, even though it was recently downgraded. And it took 5-year increments here. And you can see over most of this 40-year period from 81 to 2021, interest rates were going down. Now bonds compete with stocks for people's money. So if bond rates are coming down a lot over this period, everything else being equal, that makes stocks more attractive. So that, over that period of time, there was a major headwind in the stock market. Over that 40-year period, stocks average return of a little over 12%. You can see at the bottom, the 12.2 versus